What's up, YouTube? It's Joe Catchpolia sitting on the couch making some money investing in fractional real estate online. As usual, today we're going to get into a little bit of a nerdier subject. We're going to do some math, but I'm going to tie it all back into investing in fractional real estate. And I think it's something that's really important. It comes up quite a bit. And so what is that? Negative leverage, um, or leverage in general. There's, especially on Lofty, there's a lot of this discussion where, do we want to build up the operating reserve? Do we want to pay out a yield? Do we want to pay off a loan if we've taken a loan? Um, there's a whole lot of back and forth about this, and I think that most of the time when people are arguing about it, they're just arguing from their feelings about debt or their feelings about a certain thing, and they're not really doing the math. I think part of it is some of them don't know what math to do. Some of it is we're just lazy. Like I'm not always doing the math. You can tell from, I'm really nerdy about this stuff, but like I like to think about the ideas and I like to build spreadsheets and do certain math about it. But then there's some stuff that I think the nuance isn't really that necessary because I think that, the difference between one choice over the other might be pretty close. But anyway, let's get into it. First of all, what's negative leverage? Well, and really, the way I think about this is, is our debt accretive or dilutive? I think that's the terminology I'm most comfortable with because I started off working in real estate, working for REITs, and so they sort of use a lot more corporate finance speak. But I have noticed a lot of PE people use it this way too. So if it's accretive, it means, it's making you more money using the debt. If it's dilutive, it's making you a little bit less. One thing I want to point out, whenever I'm using articles that I found on the internet, a lot of times I'm just using one that I found that has a nice picture that I think goes good with what I'm talking about. It doesn't mean that I'm endorsing this company whatsoever. I'm not familiar with them at all. Apparently, they do like investing in property management. I mean, who knows? But they had an interesting. They had a great picture, but also they talk about your positive leverage, negative leverage in the way that I see a lot of people talk about it. And so what they want to do is they want to compare your cap rate to your interest rate. And so if my cap rate's higher than my, or yeah, if my cap rate's higher than my interest rate, it's positive leverage. It's making me money. If my cap rate's lower than my interest rate, it's negative leverage and it's making me money, and it's losing me money. Um, and I agree with that. I think that's true. But I think what gets lost on a lot of people is, so they're talking about they're saying the difference in interest rate, but then they're talking about your cash on cash returns. But those things are different, right? And so what this discussion is ignoring is the mortgage constant. And so I want to talk a little bit about that, or people call it the loan constant. This site, this Janover Multifamily Loans, they have a lot of good stuff like this. I think this is a good source to actually read up on, find formulas for stuff. This is not what they're for, right? They're not an education site, but I just come across them all the time when I'm like looking up ways to like actually show your terms. And so your mortgage constant is your debt service divided by your loan amount. And so how is that different from your interest rate? Well, it accounts for the principal payments that you're making as well. And so one of the things I wanted to point out is your loan constant is not the same as debt yield. I don't know why, but I feel like this is confused quite often. So they actually have a description of debt yield as well, which is just your net operating income divided by your total loan amount. This is a number that banks like to use a lot more because it shows them about the safety of their loan. I know I'm guilty of this. Sometimes when I mean to say loan constant, I'll say your debt yield. I'm not sure why. I bet we all took the same wrong finance course at some point in time, or read a book. I don't know. It's one that I see get confused all the time. So when I say loan constant, don't think debt yield. If that didn't even pop into your head, I'm sorry if this is just making it more confusing. But okay. So what we should really be doing, if we want to think about the impact on our cash flow, is comparing your loan constant, which is your total annual debt service divided by your loan amount, to your cap rate, right? And so I'm gonna jump into the spreadsheet here, and hopefully this makes it a little bit more clear. So okay, we have a property. The property is $100,000. The NOI is $8,000. And this is, again, we're doing guerrilla math, right? I'm not breaking this down um, to the penny or anything. This is like I'm trying to explain the concept. And so we're ignoring closing costs and stuff. I mean, obviously your model has to be a lot more complex than this to really get to what you're doing. But I'm trying to get the concept out here. So, okay, so that means my cap rate is 8%, right? $8,000 divided by 100,000, that's 8%. So, in theory, if my interest rate's lower than my cap rate, according to this concept of negative leverage or positive leverage, um, we're going to be making money by taking out as much debt as we want to, right? Like we want to take out, if we wanted to borrow the full 100,000 against it, we'd still be making money because we'd be paying seven and a half, whatever it is. So like in my example, I'm going to use 7.5% interest. So if what we're doing is, the property is spitting out an 8% return, we're paying a 7.5% interest rate. Um, where you'd be making money even if you borrow the full value, right? That's the concept. But you wouldn't have positive cash flow in that scenario. And so I want to break this down. And sometimes even with a more normal amount of leverage, you wouldn't. So I'm going to do a 75% loan to value. So okay, in this scenario, we're borrowing $75,000. We're doing a normal 30-year term, which is 360 months. I'm putting this interest rate in. And so, well, first I'm going to look at, okay, so if we wanted to just say, okay, what's your interest in year one? That'd be $5,602. Those of you that want to, check that math, I'm not just taking $75,000, multiplying it by 7.5%. That would work if there was no amortization happening. But because I wanted to be a little more precise, I did my year one interest calculation. I'm using this interest payment amount, right? Adding them all up. And it actually only ends up being like $20 difference than if I multiply this by that. But that sometimes these things I want to really check and make sure that it's not going to be too far off. Okay, so I did that, but then I also calculated, okay, what if I take the monthly payment and I multiply it by 12, right? And so this is all the interest. This is all the interest in year one, and over time that goes down, right? Um, and so this is just based on the interest rate. This is the total debt service, and so when we divide this debt service by the loan amount, and so I just calculated the monthly payment, multiplied that by 12, got the total, excuse me, got the total debt service. My loan constant is 8.39%. And that's because I'm paying both interest and principal in that payment, right? And so let's go over here and look at, okay, what happens to our investment? So if we were ignoring the loan constant, we're just thinking about interest. We put a $25,000 of equity into the property, the 100,000 minus the 75. Remember, we're doing really simple math here, right? Uh, and so our profit, and you can see I'm taking my NOI minus my year one interest, and I just get my profit right there, $2,398. My return on equity in that situation is 9.59%, right? That's just this number divided by this number, right? The profit divided by our equity. And so you can see our return on equity is higher, is higher than our cap rate. So like if we just bought this outright, we'd have an 8% return on our equity if we had 100%, $100,000 in equity. But instead, we leveraged it, and this profit, after only considering the interest payment that's added, is higher than our cap rate. But if we look at our cash flow in this situation, which is um, our NOI subtracting our annual debt service, we get a different story, right? Then we look at the cash on cash return, right? So our cash flow is the amount that's different is the amount of principal payment. So our cash flow is 1,707. We're doing the same thing here. We're dividing it by the equity, and so our cash on cash return is actually 6.83%. Well, why would we do this, right? Like from a cash flow perspective, we're actually making a lower, cash on cash than if we had just paid all cash for this property. Um, I set this up on purpose so that you can see, you can have a deal that is positive leverage from an interest perspective, right? And from a profit perspective, you're pure profit. You're actually making money. And the reason that I'm saying you're actually making money is because when we look at our cash on cash, the difference in these two numbers is just money that's paying down the mortgage, right, or paying down the debt. And so it is money that we're making. We're paying off our debt, and so that's money, and so it's profit. But at the same time, on a cash basis, uh, we're losing. We're worse off for using the debt than we would have been otherwise. And so, depending on whether you're thinking about it from a profit perspective or a cash flow perspective, this 7.5% interest rate might be accretive or might be dilutive, right? It's accretive uh, to our profit, to our actual return on equity, but it's dilutive to our cash on cash. For whatever reason, I think this throws a lot of people off. I think it's because most people, when they think about their interest rate or when they think about their loan, they're not separating out the principal payment from the interest payment in their brain when they're thinking about this conceptually. And so, this discussion came up today. I was talking to a couple of different people about this property on Lofty, Sarah, right? It's Sarah Ave, where we've got like a $12,000, debt that we have to take care of right now. The most recent vote was to uh, use a loan. It's going to be an interest-only loan at 12%. Um, And so there's some people that think, okay, no, we shouldn't do that. We should do a dilutive capital call, or we should take all of our yield and pay off that debt instead of just keeping it outstanding and just pay the interest. There's a lot of discussion about this, and so 12% seems like a high interest rate, right? And but one of the things, just like we were just looking at, is what we have to do is compare it. Is that 12% debt, is it accretive or is it dilutive in our situation? Um, because it's an interest only loan, there's the mortgage constant that that calculation. And I actually think when they talk about your loan constant on here, they have a little thing about the shortcomings of it, and it's you can't effectively apply this to interest only loans, right? And so the fact that we have an interest only loan makes it so we really only have to compare our cap rate to our interest rate, right? And so if the cap rates and so we if the cap rate's higher than our 12.76%, or no, sorry, or I'm already looking at my answer, right? If our cap rate's higher than the 12%, then we should just leave the debt outstanding and just continue to pay that interest rate every month, and to do that as long as we possibly can, right? Because we're getting because it's accretive to our profit situation, and from a cash flow perspective. And so let me just show you. It's very difficult because Lofty's always giving you these stupid numbers, right? Projected rental yield 16.21%. This is based off of our current price. When I did my math, I did it at $20. It's actually a little bit lower than that. But so I just wanted to do a really, really quick and dirty, NOI calculation, because as always, they don't have repairs and maintenance. They don't have a vacancy collection loss. I like to add those in. And so, okay, I did a rental rate at $900 a month. Okay, so your gross potential rent is going to be $10,800. I did an 8% vacancy collection loss, 15% management fee. I think maybe we're going to move this to Hem Lane and get it to a 10%. Not positive about that. But that would save us $500, although maybe not, because leasing fees and the format is a little bit different. Property taxes, I just pulled what Lofty had, maybe more, maybe less, I don't know. Same thing with insurance, I just took what they had because I'm just trying to look at this really quick. If we really wanted to get an answer on this, this is the way that we look at this and figure out when I'm saying, like, if we're mostly talking about feelings versus math, you know, this is the math that we really have to do if we want to make, the best possible decision. Dow cost is $750. This is something that every single DAO has annually. It's for their administration and filing fees. They talked about this got increased to this amount once they did the consolidated tax statements, uh, which I don't know. I mean, I feel like it's pretty terrible because those tax statements were horrible, but we're paying this amount. Um, One of the things for really cheap properties like this, it's a huge amount of our total, right? Like um, well, let's look at it exactly what it is, right? Like equals this divided by our annual revenue. Oh, okay, let's see. I think I just need to expand that. Yeah, it's almost 7% of our total revenue, right? That we're paying just for the administration, the administrative fees to be on Lofty. Um, it's a really good, sign that like it's a I think it's a part of the reason that properties don't work as well on Lofty when they're these like really low rent, cheap properties. Just the extra little costs involved with being on Lofty is it creates a significant disadvantage to this property, right? I used a 5% repairs and maintenance. I actually think this is really low. Um, but I don't know. I don't know anything about the property. This is it's a good rule of thumb in some markets for some price points. I think where this is, and it's five. I'm using 5% of the rent. Um, Honestly, I think it's probably got to be a much bigger number, and it might be so big that it just wipes out our NOI. Depending on what's going on. Probably not, but in a typical year. But I mean, it just takes one turnover to really wipe out that whole year of NOI if it's a little bit rough. Um, but anyway, we'll get back to that in a minute. But so, okay, then I took what's our implied value here, right? I took our token price of $20, multiplied it by the total outstanding tokens. And so at the moment, this property, even though, we're saying the underlying asset price is 93,000, but it's really, we have to look at the economics that we have to deal with, right? And so we have an implied value of under $40,000. And so when we look at our NOI compared to this implied value, our yield on that, and I don't have a good name for this, I just call it yield because, one of the things with fractional real estate in general, what we're running into is we have these sort of new situations, especially on Lofty, because they do so many things weird. Um, and because the token prices don't match, sometimes they're so far off from the real world prices. It creates these situations where like you can't just we just have to start, making up a little bit of your own stuff as you go along, because it is, we're in a new, it's a whole new world here. But anyway, our yield, just on my really simple gorilla math here is 12.76%. It's significantly below the 16% that they've got as the projected rental yield. I honestly think if I were going to spend some time on this, I probably think it's even lower because, like I said, repairs and maintenance should probably go up, although maybe our management goes down a little bit. Um, in any case, if this were accurate, right, and I'm comparing 12.76% to the 12% interest rate, I'm perfectly comfortable leaving that, just paying that interest forever, paying out yield to ourselves, right? So, okay, we pay that interest. We don't pay the principal. Instead of paying down the principal, we pay ourselves yield. Right now, I'm ignoring the idea of the operating reserve, but that's something. We'll talk about that in a second. But so paying that out that yield, and then you're better off buying $20 tokens in this property that are paying us this 12.76% yield than you are holding the token and having that debt paid within it, right? Within the structure. And that's because it's accretive debt and it's positive leverage. Now this is a very, if my number's this close, I might still decide to pay off the debt because, it's a risk-free rate, right? If you pay that debt off, you are sure you're getting that 12% return, where when we're doing this math here, we're making a projection, right? And so sometimes if it's close, you might still lean towards paying off the debt, um, or not. And then the other thing that, when you look at this, And I know it's a lot, right? I mean, sometimes some of these discussions, like, it's maybe stuff I spent half a semester on, and we're really like, I'm trying to like plow through it in an evening in a 30-minute discussion. But the other thing we have to think about is, okay, we can look at if the debt is accretive or dilutive to this particular property, but we can also look at it on a portfolio basis, right? So there are instances where if my portfolio level returns, on average, I'm making a much higher return than I am in this particular property. But for whatever reason, I'm able to put debt on this property that's got a lower yield. Sometimes in that situation, it makes sense to have a negative leverage loan on that property. That property is actually, from a cash flow and maybe even from an income perspective, losing money every month. But because I can take that cash and put it to work elsewhere at a higher yield, um, it might make sense to do that. Now, often in that situation, you'd start to think about, okay, well, wait a minute, why don't I just sell this asset and take that cash and use it elsewhere? And normally this comes into play, um, well, in a couple different ways, but maybe, if you fully depreciated or if you have a very low basis because you've done 1031s, right? And so you don't have something else to move it into, and you don't want to use that cash. You need the cash, right? You don't want to have to just move it into another property. So sometimes tax concerns will keep you from doing that. And so there are situations now you could move it into a higher, cash on cash property, but there are other reasons too. There are business reasons. Sometimes there's balance in your portfolio. Maybe it's a core product, right? Like a lot of times on the commercial side, people will have these like properties that they think of as like very, very low risk assets. Although, if you look at what we defined that as 20 years ago, uh, today we'd laugh at ourselves a little bit. You used to have like downtown office buildings. People would think, you had long-term leases and would think those were like very safe and pay, ridiculously low cap rates on those. But anyway, I digress and sorry about that. But so sometimes, even if it is negative leverage for the property itself. If in our portfolio in general, we have the ability for higher yield, and there's some reason that we wouldn't want to pay off this property, it might still make sense to pull debt on that property that is negative leverage. That's all I want to make that point, and then I got sidetracked. So sorry about that. So and then, like I said, I was ignoring I'm just saying pay off debt or pay ourselves yield. This is sort of ignoring well, what about building the operating reserve? And that is, so it's a tough question. It's one that I haven't done a lot of math around. And the reason is, in my own personal portfolio, and whenever I've done this for, larger investment companies, we never get in these situations where we have no operating reserve, right? Like all of these properties on Lofty were just run extremely imprudently, right? I mean, and so you just never run into it's very, you rarely run into these situations where you have no reserve. Um, Often when we did, you would use debt because you just want to have that reserve. So we'd actually take out a loan, we'd recapitalize, take out additional money to use as the operating reserve, and then, from there, we're doing the debt calculation as far as like, does it make sense to pay that debt down or pay ourselves? Um, but you just always want to have that reserve, and some of the people, some people I think, and then once it's full, we also just continue to pay into that reserve on a monthly basis, and let it, to continue to accrue. Um, and not have it, unless it got ridiculously large. I think it doesn't make a ton of sense to ever cap it. Um, well, I mean, there's some cap, but I think our caps on Lofty are a little bit too low. Especially for the age of the products and the markets that they're in. I would want to have more operating reserve than we have in most cases. And so I guess so that I think that's a tougher problem. I mean, I think I very much want us to have these operating reserves, But at the same time, um, when we have the ability to take out loans relatively easily, and we also have, you know, what seems like pretty easy capital calls. I mean, I haven't been involved in one where we didn't actually fund one. Um, so it's not super worrisome to not have the operating reserve, at least in this environment, right? But there's the reason that you always want to have it and not rely on that debt is, like, for example, if the economy goes bad and all of the properties are struggling on Lofty, well, all of a sudden some of our borrowing ability might disappear, right? Like there might not be. I mean, right now we've already seen the Universal Lending Dow is not lending at all. We're taking a loan from the Earl Dow, which that money is definitely, not infinite, right? And so I think that's one of the reasons, I would want to not pay down the debt and would want to increase the operating reserve. And then after that, because I just always want to have that cushion and I don't care about the economics of that operating reserve. I don't care about the math on it. A lot of people think about, and this is probably a separate rant, but I think I'm going to get into it here anyway. Before I forget, please like and subscribe. Um, in the description of this video, there's a link to my Discord channel. It's just a generic fractional real estate investors channel. We talk about all different platforms. And so, feel free to join that, jump in and have a discussion about any of this. Also, in my Discord, sorry, in the description to this video, there are links to all the platforms that I'm currently investing in fractional real estate on. You can feel free to use those links, but just because I've invested on those platforms doesn't mean that you should. You want to do your own due diligence and on the platforms themselves and on the properties. And if I didn't already say it, I'd like you to tickle that like button. I think that's all the stuff. I always forget to do that in the beginning. Every once in a while, I remember now. But so back to, the operating reserves, and it is a little bit, there's all these people trying to do things like, we need to be getting some yield on it. There's people talking about putting it in folks finance or putting it on, Bitcoin or doing all these different things with your reserve. And I think, and I think a high yield savings account, when people mention that, that's perfectly fine, right? I want a as close to zero risk, uh, you know, um, asset when I'm keeping my reserves. And I really don't care what the return is on it. And the reason I'm saying that is one of the things when you do, when you look at your math and your portfolio theory and you're making projections long term. So, and I think I've said this a lot of times before, it's really easy to make a lot of money in real estate if you're able to stay in the game, right? But one of the things but the if part, that's the really hard part, right? I think a lot of the people investing in the real estate industry today did not live through the last downturn, right? 2008 seems like forever ago. And I'm not saying that I think we're having that same scenario now, but I think the possibility always exists, right? And so the more we try to, the more we try to, completely optimize our capital structure and get a return and a yield on everything, the more fragile we make our structure, right? And uh, the thing that happens, we saw that a lot leading up to the last downturn. A lot of new types of securitization of debt, and a lot of people thought, oh, I have a HELOC on my home. That's what I'm going to use in case of emergency, or I have credit cards. And one of the things that you find out really quickly in a downturn is a lot of those sources of debt disappear, right? Your credit lines get cut in half or get reduced or even maybe just disappear altogether. I had that happen on a number of my credit lines. No change in my payment history or credit or anything. Completely just driven by the macroeconomic environment. You think, oh well, I have a contract with my bank. I have a HELOC. Well, one of the things that I learned about that I didn't know about before that is these MAC clauses, right? Your material adverse change. It's in almost every loan document, line of credit, anything like that that you have. It basically says if there's something that happens after we do this loan, we can change your credit limit or whatever it is. And that's what most of the lenders pointed to when they said, okay, I know we gave you a $50,000 line of credit, but now it's 5,000. And so I think a lot of those things. So counting on having debt in the instance when there's a problem, I think is really missing the point of what an operating reserve is for, right? Like that money is there for when there's something wrong, and it's not just the capital. It's for things that not just things that we're planning for, but also unexpected things, right? We want to have reserves when things are going worse than we thought they would, right? And then, sort of the same idea as far as investing it in other, other things like Bitcoin or wherever we want to put it. Um, I know there's a lot of crypto guys on here that think, okay, it's the best investment and it's going to go up forever, but the actual history of it is it goes up and down significantly over time, right? And the problem is if it's down at the time that we need it, that gives us a problem, right? So we want to have um, as secure of a reserve as we can, in my opinion, right? And so I guess in general, like I always want to have a full operating reserve. And then whether or not we have more debt or we're paying out more yield is just dependent on, well, what's the yield, what's our actual cap rate relative to our interest rate, and also what's our cap rate relative to our debt constant if it is a loan that's amortizing. And I think that's what we should really be looking at on each of these. But then getting back to this one in particular, and I think this is true for a lot of them. When I start to do the math around, this is a good yield because this property implied value is 39,000. As soon as you get this up to if you ever got up to a $40 token price, $80,000 real world value, all of a sudden that yield's so low, we can't have any, there's no debt on it that makes sense. Uh, and so, and because we have these like large costs from Lofty that don't fit, like a lot of these, I don't think this is a good fit for Lofty, right? I think the actual, and I mean, I think that's been shown already, but I think once it's up and running and has a tenant in it, well, or even maybe once it's fixed up, it doesn't have a tenant in it, the highest and best use for us might be to get this off of Lofty, right? Like if we can sell this, and if the real world price is actually anywhere close to this 93,000, um, we're looking at, okay, we have 12,000 in debt, uh, you know, let's see, we got I should have done this before. I always want to talk about one more thing. So let's say equals that times, what are we doing? Point 9. Nope, what are we doing? Nope, nope, nope. 93,000 equals this one times point 0.9. So that's our selling cost. Nope, 0.09 equals this minus this. And then we're going to subtract our debt. We've got $12,000 in debt equals this minus our debt. And then we divide this number by our outstanding tokens. And yeah, if we sold this in real life and we got 93,000 for it, right, which is this number here, underlying asset price, who knows if we would or not. Looks like we get about 37 bucks a token, right? And that is after paying off this debt. Um, is this a property that when it's fully up and running is ever going to be a $37 token? I mean, probably not, and this is why for a lot of these, the more I do get into the math on them, the more I decide, you know what, maybe just paying this off makes the most sense. And so what's the problem here? Well, okay, the first time we have a real turnover that's more expensive. I mean, this is just a very generous yield, and it's the yield on a very low price point, right? And maybe we get a higher rent, right? If it turns out we're actually going to rent this for 1,200, that changes the math quite a bit, but it doesn't look like that's what it's going to be. Um, so I guess on this one, and this is actually what I come out with a couple of different people who I was talking to today. I think taking the loan makes sense, just paying the interest rate at the moment, getting the unit fixed up, and then we get it rented out, and then we can really see, okay, what does this look like? What do the operations look like? And then we can make a little bit better of an informed decision. Um, I think I probably don't want to pay the debt down. I probably want to let the operating reserve build up, and then, um, the one of the problems is a balloon note that's just, maybe they'll extend it, maybe they won't, maybe we have to pay it off in a year. But, we have the ability to do a dilutive capital call between now and then. It's not a lot of money. It's like $12,000 that's owed. Uh, I don't know. I think but I think this is the way we need to really be thinking about it. We need to look at, for me, the operating reserve should be non-negotiable. We should build that up. I would actually be okay with taking out debt to have a full reserve. I don't know that there's really a lender at the moment that would lend that to us, right? And so I think my real answer is let the debt ride, build up the operating reserve. But one of the things that comes into play a lot is, well, if we don't pay any yield, uh, the investors in this deal, on Lofty in general, they just really punish the token price. And so if anybody wants to exit anytime in the future, in the near now, they're going to have a very low token price. And so what ends up happening is you have a lot of people that want to get out of this, don't want to get out of it for 20 bucks. And so then they say, hey, let's sell this. $37 sounds pretty good to me, right? And anybody who bought it recently, like me, when I look at this and think, yeah, $37 would be great. Like, and maybe you don't get to that, right? Maybe we do some concessions and whatever it is, and maybe it's 30 bucks. But even that, from if you bought tokens today at 20, it's a 50% return. Um, I don't know. I mean, this is why I end up pushing for so many properties to be sold, because the math just really looks like that's the right answer. Um, this is one of the things that I hadn't really thought a whole lot about. But when we have a fixed Dow cost that's almost a full month's rent every year, that's really hard to overcome on a cheap property like this, right? Like this is already in a market that doesn't, is really tough because you have longer vacancies, you have rough turnovers. And if on top of that, we have this extra expense, uh, and then when we are borrowing money, the fact that 12% is a good deal for us because we're used to 13 and a half that we were paying to the universal lending Dow, um, which, if we could go and get a mortgage on this and we're paying 6.5%, and we could pay off that um, and fund a reserve, that would probably be the ideal thing, but we'd need someone to back that mortgage. What, it wouldn't be terrible. Maybe even take enough cash out that you pay a little yield too, and then, oh, bam, we're boosting this token. But the problem is I think that the yield, this is just a really fragile yield, even, so I don't know that I do want to add more debt. But you put a 30 or $40,000 loan on this, 7 or 8% interest rate, yeah, you could, that might be something to explore, right? On a lot of these where we need to build a new reserve. Um, we don't want to pay 12% interest forever on the only real available capital. And the dilutive capital calls, anybody who doesn't want to participate in that also really doesn't want you to don't want to get diluted at such a low price relative to the real world value of the property. So, um, that might be an alternative to explore other than selling it. But honestly, a lot of these properties, the best move is probably just to sell them. And I know that is uh, a rough answer for anybody who spent 50 bucks a token on this. Um, But they're in the same boat as us, right? Where we have something that's at the moment worth only 20. Maybe we could sell it and get to 37. I don't see any way of us, our operations getting us to that high of a yield. I certainly could be wrong. Uh, I mean, we have seen some of these little ones that actually do pretty well because they've had some rent increases and whatnot. But again, it's also they're doing pretty well because it's lofty math where they're just annualizing last month. They're ignoring the fact that, oh, well, the month before we spent 3K on, fixing whatever it is. So it is. I don't know that there are any that are really paying out average returns. Um, any of these little cheap ones that make any sense. So I guess this was a long one today. I think we covered a lot of ground. I'm sure that there are some points that I didn't make clear. If you want to talk about it more, feel free to put questions in the comments. I'll try to answer those. If you're wondering why my picture is down here, it's because I'm just absent-minded, and I guess I put that down there. Um, can't believe I just now noticed that. Uh, I wonder if I moved it at some point. I don't know. But if you want to talk about it in the Discord, jump in there. And if there are like certain, I'm sure that some of this stuff, because I just tried to go through it really fast, maybe wasn't the most clear. If you think there's one small topic in this that deserves a whole video, let me know. Or if you think there's somebody else on the internet who's already done one that explains it better than I did, which I'm sure is the case. If you have a link to that, I'm happy to link it in the Discord so somebody can look at that as well. I think that's really everything at this point. So until next time, you know the thing. Oh, did I tell you to do the thing with the bell and the like button? Um, it's been really fun seeing how fast the channel's growing. I think the shorts are helping. Are those annoying when they pop up in your feed? Because I know I'm kind of gearing those towards people who haven't been watching the videos. So if you saw those and you've already been watching and it's like, oh, get out of here, they're probably not that useful, well, except for explaining whatever my most recent video is. But anyway, I think that's really everything. Until next time, I'm going to keep making mistakes so that you don't have to.